Which property markets fit what type of investors at what time inside those property cycles? Hello and welcome back to the Lazy Equity YouTube channel. When we're buying investment properties, we obviously need to get servicing for those properties. And servicing comes from income generated from our salaries, income generated from the properties. And those two different types of incomes basically service the loan to be able to hold the debt and create the trust within a bank to be able to finance that. Today, we're going to be speaking about this factor being yield. Now, the property's yield, which generates the income coming in from the rental of that asset, contributing towards the costs of holding the asset for an investor's profile. That investor's profile has a financial makeup, and it's basically going to suit the financial makeup for a client. And that's why yield is so important to understand for any investor going into their journey. Getting your yield wrong from the start can mean years and years of recovery, and that puts you out of the game and not able to actually buy a property that is going to service you in capital growth, because at the end of the day, capital growth is what we're really all aiming for, but the yield is there to allow us to get into the next property. Obviously, it's not just yield, as I touched on, it is also your salary, but these two components are very, very important for the banks to get trust and understanding that you're going to be able to manage those repayments going into the future. So when we're looking at yield, there are two different types of yield that we talk about. We talk about the gross yield and we talk about net yield. Gross yield is basically the rental income divided by the property's purchase price as a percentage. So if we're looking at the purchase of a property, which is, call it $500,000, and the rent it creates is $500 a week in rent, that is a 5.2% yield. The same is said for $600,000 at $600 a week in rent, $700,000 for $700 a week in rent. That's a 5.2% yield. Now, net yield at the same figures of a $500,000 property renting out at $500 a week in rent, let's assume the holding costs of that property are going to cost us around $30,000. Now, the $500 a week in rent contributes over a year to $26,000, but it costs us $30,000 to pay off and hold the property for all the mortgage repayments, the rental management fees, the insurance, and all other costs assumed to hold that property. Now, it costs us basically more to hold that property than it does for the rental income of that property. This is going to result in a negative 0.8% yield. So basically, this is going to cost us more to hold the property in time. And for some investors, that's okay. But for some other investors, potentially that's not going to work for their financial profile. And in this video, we're going to go into explaining a little bit more around why that matters for different people at different phases, and why people need to shop in different suburbs at different price points at different times during their journey. Now, as property investors, when we buy investment properties, that's going to be purchased with a certain yield on it. Now, if we do make mistakes and we do buy a yielding property that doesn't support us to get a new loan in the future as quick as what we wanted to, it's not the be all and end all. You can forego some rental yield in exchange for capital growth, and this comes into different market cycles inside that property. But this is where a lot of investors get it wrong, is when they look at rental yield on a property and they assume that the property is not a good property to purchase in. In fact, it's probably a good property to purchase in, and potentially it may even be good into the future for the amount of growth that's still expected. When a property's yield gets absorbed, all it really means is that the value of the property that you've purchased or you're purchasing is growing faster than the rental rate inside that market. And this is natural because every single rental contract is attached to a time frame. The rental contract might be on a 6-month lease, a 12-month lease, or an 18-month lease. In those periods, those prices cannot change. Those prices are also significantly lower than the valuation of a property price, being $500,000 versus $500. Now, when we're looking at a market that has a higher amount of competition, the competition inside that market is what changes the price point of that market. If we're looking at that property at a $500,000 valuation today, and that property is going up by 2% in a month, next month, that property is sitting at a $510,000 valuation. That changes the yield because now the valuation of the property is higher and the rental price is still the same. And that's only within a 1-month period. And so comprehension around why the rates are changing and the pace that they are changing at will help an investor understand how much traction there is inside a market. The quicker the yield is falling inside an area, especially when there's a growing rental market, means there's there's an extremely more aggressive amount of capital growth inside that area. So quick falling yields does not necessarily mean it's a bad investment property. It just might not work for your financial profile. While capital gain is always going to be the tool that allows us to create deposits, yield is always going to be the factor that helps us to release the equity for those deposits. Now, if you remember what I was saying earlier, the banks are going to assess you against your income. That's being generated by your wages as well as the rental property. The other side of it is that the bank is going to look at the suburb that the property is placed in to see if there's going to be enough forward forecasting demand inside the rental market as well. This comes in line with having a confidence from the bank to say, okay, great, we see confidence in this type of property for this type of investor. Now, if you're an investor who typically earns a lower income, you're going to have to prioritize a higher rental return on that property. Quite typically, a higher rental return property is going to be at a lower price point. And this is because the growth has not yet occurred. If you look naturally across the country, if you're looking at $1 million houses or $2 million houses, you're going to see a very small yield inside those property types. If you're looking at price points that are sitting around the $400,000 or $500,000 mark, these types of properties hold a far more aggressive yield. And this is really good if you're trying to balance out your DTI. Now, your DTI stands for your debt to income ratio. When the bank services you for a loan, they're going to look at the amount of income that you generate, and they're going to give you a portion of debt according to the income that you produce. Now, typically that rule sits at 6 times the debt to your income. So the DTI cap here is 6 times. Now, this doesn't obviously take into account your living standards and your personal entertaining. This is purely just debt to income. Those do get consolidated into your analysis, and those are typically called your liabilities and the other costs that are assumed with your costs of living. But the banks have actually been quite responsible around this, and while we get lent 6 times our debt to income ratio, the banks actually add another 3% on when they assess you as a borrower. That means that they need to see the comfort of you being able to repay 9 times your income off your ability to service a loan. So while we get lent 6, we're actually getting serviced against 9%. And this is one of the things that is actually in place that helps Australia stay out of financial crisis, because we've got this 3% buffer margin on everybody being able to repay their loans. Now, Australia being such a property interested country, this is a responsible decision by APRA, and it keeps us safe as property investors and obviously the country that loves to invest in property. So going back to these 2 different types of investor profiles, a lower income earner still needs to look at lower cost properties because the debt on those assets is going to be cheaper for them to hold, with the rental recovery coming in from a stronger yield, proving safety and security to the banks and the lenders for getting the loan into the next property. The side effect of this, however, comes in line when you are buying early inside a market before it's even started to see growth. So potentially you're not inside that growth cycle at that stage, and you're waiting for the growth to come in. This is where picking your markets becomes really important, because obviously we don't want to buy for just yield, especially when it comes to residential real estate. We want to buy for equity at that stage. So being early into markets at lower price points for lower income earners requires a little bit more education going into these types of property markets, because there isn't yet enough visibility of the market movement. The things that indicate to us that a property market is about to move, especially at the lower price point, is the tightening of vacancy rates. As vacancy rates start to tighten inside an area, especially around 1.5% and lower, we can start to see there being a necessity for people coming into the area to live and reside. This obviously brings population, but that population isn't going to just rent property, they're also going to buy property. And so the need for people to come into this area is a really strong signal that equity is on its way. And obviously that's what we're in the game for. And so as a lower income earner, you would want to make sure that you're watching the vacancy rate data inside that property market to make sure that you are buying at the lowest price point possible that's going to service you for a loan or a yield that is supporting the low price point, because you're going to have a low price point with small debt, ideally being supported by a higher rental income and stronger yield. Those 2 mechanics are going to be required when you want to repurchase another property. For higher income earners, they don't necessarily need to wait for the cycles to come forward. They can actually buy within a cycle because the salaries that they create from their employment is able to repay to the bank and create the trust that the bank needs to see in being able to repay those loans from the higher debt. Now, typically speaking, when you are in higher growth markets that are actually in movement, again, those yields are already absorbed to a fair portion. But because we're going to be able to make those repayments to the bank because of our salaries, the banks will give us the ability to buy those properties with a higher debt. Now, a higher debt comes in line with the property obviously costing more money. As an investor, why would you really want to buy a property that's going to cost you more money? Well, quite simply, because if the property is a higher value and that property is still going to be making 10% or 15% return in that same time period as what a low price point property would, that return is attached to the valuation of the property. So instead of it being a $500,000 property and potentially it's a $900,000 property, and let's assume they're both growing at 15%, that property at $900,000 has created $135,000 of equity against a $500,000 property, which has only created $75,000 in equity. Growing your returns of higher values obviously makes fundamental sense in being able to expand your portfolio a lot faster. But again, you need to make sure that the yield is going to service your lending profile. So you can see why yield isn't just rental income attached to the purchase price of the property. It really is a tool that helps you to understand what you should be buying at what stage within your investment journey. Now, it's very common where you get a lower income earner starting out their investment journey at lower price point properties and very quickly escalating up into more expensive properties. And again, that is because the rental cash flow is going to be compared to the purchase cost of that property. Over time, while that property's rent increases and eventually gets to a neutral and then positive gearing state, the investor's profile becomes more attractive to lend against into the future. This is also coupled with increased value of that asset, which also then changes the LVR, or the loan to value ratio. The lower the loan on the property according to the valuation of the property means that there's less risk again for the property investor to be able to buy another property in the future. Coupling this with strong yield at that time means that the investor that started off small will be able to grow faster a lot more aggressively if they buy at the right price point for their income and their servicing. This is different obviously for higher income earners because higher income earners can take advantage of higher price point assets attached to potentially the same amount of percentage return, but providing a larger amount of equity gain. A really good way to test this out for yourself is to go into one of the Big 4 banks lending calculators on the websites and go and plug in your income and have a look at what your servicing amount would look like, and then pretend to buy that property and hypothetically own that debt, re-add it into the calculator and see what that looks like for another loan amount in the future. Basically, you're trying to trick the platform into thinking that you own the property that's creating a rental income to understand what your next purchase would be. Planning your purchase today for your next purchase tomorrow is really how successful investors get ahead. But if you don't want to do that, you could just click over here to the Roadmap Lite, and the Roadmap Lite is a tool that we've created for anybody who wants to understand what their borrowing power would look like if they were to hypothetically purchase into the future and create their portfolio value over a 10 to 15 year period. I'll leave the link in the description below. You guys can just click through there, go have a play around and see what it looks like for your own financial profile. If you've been caught up before by buying a property that has over leveraged your debt before and it hasn't allowed you to get into the next purchase, even though you've got the equity available, add in the comments below what the price points were and what that property was actually returning in a rental return. It's really interesting for us to have a look at who's buying what around the property markets of Australia. Thanks for tuning into another Lazy Equity YouTube channel episode. If you guys have any ideas around any topics that you want us to uncover and you like how we do that, let us unpack it for you and educate you around the ins and outs of Australian property investing. If you like content like this, please give us a like and subscribe. We really enjoy creating this content for you guys out there and giving you a little bit more of an insight into the Australian property market. Until next time, thanks for your attention.